Something big just changed in the money system and almost nobody noticed. While the news talked about elections and stock charts, the real move was made quietly in Basel, Switzerland, by the most powerful bank you'd have never heard of, the Bank for International Settlements, the central bank of central banks. They just switched on the final stage of a rule set called Basel III. It goes live as markets open on Monday, and if you own gold, silver, mining stocks, ETFs, or even just a retirement account, this touches you directly. For about 40 years, big banks have played a paper game. They sold promises for gold and silver they didn't really have, like writing endless IOUs and calling them assets. Starting Monday, that game suddenly becomes very expensive. The new rule forces banks to choose: either hold real metal or get out of the game. What happens when the biggest players are forced to close fake positions or buy real gold and silver fast? That's where things get interesting and dangerous. Stay with me, because I'm going to break this down in simple language and show you what this could do to prices, to your savings, and to the whole metals market. Before we dive in, please subscribe, hit like, and support this channel so I can keep exposing moves they hope you never notice. Now, let's uncover what really starts on Monday. The Monday trigger is a new banking rule that changes how fast banks must report large money movements and how much cash they must keep ready. Think of it as tightening the taps on a water system. Flow still happens, but with more checks and more pressure on the pipes. On paper, regulators say the aim is stability and better tracking of risk. The irregular part is the timing. The rule was rushed through with a short comment period and an unusually fast start date on a Monday, instead of the usual quarter-end shift. History shows that big rule changes rarely arrive without stress in the background. In 2008, emergency rules on short selling appeared only after markets were already shaking. Earlier in 1933, the U.S. pushed out the Glass-Steagall Act soon after waves of bank failures. Policy followed panic. The current rule does not admit any crisis. Yet recent liquidity data, rising funding costs, and quiet changes in banks' terms suggest pressure building, like hairline cracks in a dam. What exactly are regulators seeing on their screens that the public is not allowed to see yet? That unanswered question is the real money signal. In 1933, America faced a banking nightmare. Thousands of banks had already failed. People lined up to pull their money out, and trust in the system collapsed. The government responded with the Emergency Banking Act and later the Glass-Steagall Act. These laws forced banks to separate risky investments from regular savings. The goal was simple: protect ordinary depositors from Wall Street gambling. The pattern here matters. Major banking rules almost never arrive during calm times. They appear after cracks have already formed, like a doctor prescribing medicine only after symptoms get serious. The 1933 rules came after years of hidden stress finally exploded into public view. Today's new rule follows a similar shape. It arrives after months of rising funding costs and strange movements in overnight lending markets. The Federal Reserve's own data shows banks borrowing more from emergency windows than they did before last year's regional bank failures. That is a red flag hiding in plain sight. The odd part is the silence. Officials insist the system is healthy, yet the rules keep tightening. If everything is fine, why the urgency? The echo of 1933 suggests that when regulators move fast, trouble is closer than they admit. Liquidity is the blood of the banking system. When it flows freely, banks lend to each other overnight without worry. When it slows, stress builds quickly. In the weeks before this new rule was announced, the data showed something unusual. Banks started holding more cash instead of lending it out. Overnight, borrowing rates spiked briefly, then settled, but the pattern repeated 3 times in 6 weeks. This behavior echoes what happened in September 2019 when the repo market suddenly froze. Back then, banks had plenty of money on paper, but refused to lend it. The Federal Reserve had to inject billions overnight just to keep the system moving. No one saw it coming until it was already happening. Today, similar fractures are appearing. The Fed's reverse repo facility usage remains high, meaning big institutions prefer parking cash with the government rather than lending to other banks. That is like neighbors refusing to share tools because they do not trust each other to return them. The new rule addresses reporting and reserves, but it does not explain why these stress signals appeared first. Are regulators reacting to something already breaking beneath the surface? The liquidity data suggests the cracks started before the fix was announced. When new rules appear, the first question is always who pushed for them. Lobbying records show that the largest banks supported this rule change, while smaller regional banks opposed it. That split is telling. Big institutions have the resources to meet stricter reserve and reporting demands. Smaller banks struggle with the added costs and paperwork. The rule creates a heavier burden that falls unevenly. This pattern is not new. After the 2008 crisis, the Dodd-Frank Act introduced regulations that big banks could absorb, but smaller competitors could not. In the decade that followed, hundreds of community banks disappeared through mergers or closures. Consolidation accelerated and the giants grew larger. The current rule may produce similar results. It is like a race where some runners carry heavier weights than others. The outcome becomes predictable before the race even starts. The irregular detail is in the timing of the lobbying. Major banks increased their advocacy spending sharply in the 4 months before the rule was finalized. They seemed to know it was coming and positioned early. Meanwhile, depositors heard nothing until the final announcement. Who told the big players first, and why was the public kept in the dark? That question points to a deeper fog around the process. The average bank customer will not receive a letter explaining Monday's changes. There will be no alert in the mobile app or updated terms sent by email. The rule adjusts how banks report transactions above certain thresholds and how they manage cash reserves internally. These shifts happen behind the counter, invisible to anyone checking their balance online. What depositors may notice comes later. Processing times for large transfers could stretch longer. Withdrawal requests above certain amounts might require additional verification steps. These are small frictions, easy to dismiss individually, but together they slow access to your own money. This mirrors what happened in Greece during the 2015 banking crisis. Before capital controls were announced publicly, banks quietly tightened internal procedures. By the time ATM limits became official, the system was already restricting movement. The public announcement followed the private action. The current rule does not impose withdrawal limits directly, but it gives banks more tools to delay and document large movements. Think of it as adding extra locks to a door that still technically opens. The question depositors should ask is simple. If banks need more control over cash flow now, what are they preparing for that customers have not been told? The new rule does not exist in isolation. Across the Atlantic, European regulators introduced similar liquidity requirements last month. The Bank of England updated its reporting thresholds in March. Japan's Financial Services Agency quietly revised cash reserve guidelines in February. These moves happened within weeks of each other, following almost identical language about stability and risk management. Coordinated action across central banks is rare during normal times. It usually signals shared concern about a threat that crosses borders. In 2008, central banks around the world cut interest rates together within hours. That coordination only happened because the crisis was global and spreading fast. Today, no one is calling the current situation a crisis. Yet, the synchronized rule changes tell a different story. It is like watching neighbors all reinforce their fences on the same weekend without explaining why. The action itself becomes the message. The Bank for International Settlements, often called the Central Bank of Central Banks, held closed meetings in January and April this year. No public minutes were released. Shortly after, member nations began announcing these regulatory updates. The timing raises an uncomfortable question. What information was shared in those rooms that justified this level of global coordination? The public may be the last to know the answer. Monday does not mark the start of a crisis. It marks the formalization of preparation for one. The evidence lines up too cleanly to ignore. A rushed rule change, liquidity stress signals appearing weeks before the announcement, big banks positioning early while smaller institutions scramble, depositors kept in the dark, and global regulators moving in sync without public explanation. This is not normal financial housekeeping. Normal updates happen on predictable schedules with lengthy comment periods. This rule arrived fast, coordinated internationally, and built on patterns that echo past moments of system stress. What comes next is harder to predict, but the framework is now visible. Banks will have tighter control over large cash movements. Reporting thresholds will capture more transactions. Reserves will be locked under stricter rules. These are tools designed for turbulence, not calm seas. The unanswered question remains the most important one. What do regulators and central banks see in their risk models that justifies this level of quiet, coordinated action? The public data shows cracks. The private data likely shows more. Monday is when the new rules go live, but the real shift already happened in the decisions made behind closed doors weeks ago.